Hi, I'm Jamie Turney from Lawrence, Kansas. I'm here to spend some time with you about annuities. I want to do a little recap or a little brief overview. Remember, life insurance is purchased in case you die too soon. It's purchased with premiums that you already have a predetermined death benefit. An annuity is the opposite. It is purchased in case you live too long and need some money to retire with. An annuity is purchased with premium payments to accumulate those assets that you can use for retirement income. Let's go over a few of the characteristics. First of all, an annuity is set up for long-term savings. That's very important that you understand that it's for long-term. In an annuity, if you take money out prior to age 59 and a half, you will incur a 10% penalty from the IRS. Again, an annuity is used for retirement income that you cannot outlive. It protects a person against living too long but not having enough assets, maybe from their 401k or from their job. It also provides a guaranteed monthly income for as long as that client lives. It also is tax deferred, which is a great benefit. The interest and the growth is not taxed while you're accumulating. You do not pay taxes on that interest or that growth until you start taking that money out, and your principal will not be taxed. Also in an annuity, there are usually no maximum limits like you have in a 401k or an IRA. There are no maximum limits. That makes it very flexible for clients, and there are sometimes minimum amounts to start an annuity, and those will be discussed in each contract. So let's take a look at the graphic. I like to teach annuities using a mountain as our graphic. And on one side of that mountain, we're actually accumulating or saving the money. That's the part where you're climbing the mountain. That's usually the most difficult, saving the money. It's called the accumulation or the pay-in phase. The other side of the mountain is the annuitization, also known as the liquidation phase. That's when you're pulling the money out. It's always easier to spend money than it is to save money. So let's take a look at 5 questions I want to be sure that you can answer about annuities. First of all, who are the parties involved? How can I purchase the annuity? How does the money grow once it's there? When can I use the money? And then lastly, how is that money paid out to me at retirement? Let's take a look at that graphic again. Those 4 questions, the first 4, talking about who, how can I pay it, when can I use it, those questions, those are covered on the accumulation side of the annuity while you're putting money in. Now let's take a look at who's involved. The owner is the person who puts the money into the annuity. They pay for it, just like they do in a life insurance policy. An annuitant is the person who's going to use the money at retirement time. So they really don't come into play until the liquidation phase. Now, the owner and the annuitant can be the same person, and usually is, but there are options that it can be somebody different. And then the beneficiary, that is the person that receives the money upon the owner or the annuitant's death. In the accumulation phase, while we're saving the money, if the owner were to pass away, the beneficiary will receive either the balance of the account at time of death or the principal amount that was put into the annuity, whichever is greater. The second question that we want to answer is, how can I buy or purchase the annuity? How does that money get accumulated and put in there? Well, you have 3 choices as the owner. You can either put in a lump sum, which is one single premium or one single payment. That's usually a very large amount of money. The other 2 options are a flexible payment, which gives the client or the owner a lot of flexibility. They can put in as much money whenever they choose, and it's up to them. And then there's a level premium. The level premium is designed or determined in the contract how much that premium is, and there also are minimums for that. The third question that we need to answer is, once I'm putting the money in, exactly how does it grow? How do I earn interest on that money? Well, when we're talking about interest, we're talking about earning that in 2 ways. The first way could be a fixed interest rate. That means that money or that interest rate does not change. It's always the same. It's guaranteed. You know from your contract how much that will be. It's also money that's kept in the general account, remember. Then your other choice of an interest rate is a variable interest rate. As the name implies, this interest rate varies or changes. It is not guaranteed. But the owner does have some choices. They get to choose. Where do they want to put that money? Is it in a bond, stock, mutual fund? They get to pick. Because they get to pick, they're taking the risk on the money. And because they're taking the risk, that money will be kept in a separate account. When I talk about a separate account or risk involved in the money, remember, the person selling it to you must have 2 licenses, the life insurance license and the securities license. The last question that we ask and answer on the accumulation phase is, when can I use this money? Now remember, one of those characteristics is an annuity is set up for long-term savings, but there are times that a client or the owner may want that money immediately, and that's one of your choices. An immediate annuity means that owner is taking money out within 12 months of opening the account. Now, to take an immediate annuity, that client will have had to put in a lump sum premium. That's the only way they can start taking money out, if there's money in there. The other choice is a deferred annuity. That means that owner is taking that money out any time after a 12-month period. Anytime they choose, they can start taking money out. Now remember, once they start taking money out of the annuity, they have now annuitized or moved over to the other side of the mountain, and they are liquidating. So they will be paying taxes on the interest and the growth, but not the principal. Now, the last question that I want to mention. This question is, once I'm starting to take the money out for retirement, how does it get sent to me? How do I get it paid to me? You have some options there. They're called settlement options. I am just going to name them for you. If you want more details about the settlement options, please tune in to Catherine's segment on settlement options. But those 5 are those settlement options are lump sum, annuity certain, or life annuity. So with annuities, remember, they're set up for long term, and you need to be able to answer the 5 questions. Who's involved? How can I purchase? How does the money grow once it's there? When can I use it? And how will that money be paid out at retirement? I hope this helps you understand annuities better. Thank you for your time.